we've got sort of three questions to talk about with ISAs at this time in the year, I suppose, and they're roughly speaking how we want to think about pacing ourselves over the year, if we want to do that or not, what we're kind of looking at the moment for our buying list, and how we go about managing our portfolios in terms of allocations, I suppose. So let's kick ourselves off at the top. Steve, you kind of teased at the idea of lumping it in quite a bit, or you said you put a bit more in than you meant to at this stage in the game.
Yeah, so really, I wanted to kind of stick with the old strategy of 1,650 a month, because that sort of spreads it out over the year, and it's the closest kind of whole number figure you can get to spreading it out over 12. Well, I accidentally put 30%. I put $6,000 in this morning, so I completely blew that out of the water. But mainly because I did a quick spreadsheet and I worked out all of my allocations and what they're actually supposed to be. And that was the sort of lowest amount that I could put out as like a balancing payment to try and bring things back in line and bring positions up to somewhere near where I wanted them. So for something like Deckers, I sent it to Steve the other day and he realised I only had about 38 quid in it. And it was because it was all I had left from the year before. Well, I've been able to bring that up to its allocation. I think it's just over £1,000 worth now, with a little bit of room to stretch that position out if I want to. So anything that had just a few quid in or was kind of holding positions or positions I was thinking about have now been brought up to 2/3 positions. And then over the course of the year, I should be able to build that out. I have still got a bit of money spare, Steve. I actually managed to free up a bit more money than I thought I was, but I'm trying to be sensible with it and just hold a little bit back. How about you?
I am not holding back at the moment. I've decided that as I get money, it's probably going somewhere, as long as I can see something that I think is at a reasonable valuation. Right, I'm not going to do something silly because I can't see something sensible to do, but I was doing a little bit of writing earlier this week. Listeners might well know that I write for the kind of Motley Fool's UK arm as a freelancer sometimes, and we try and think about what's timely and what people might be thinking at any given moment and try and say things that resonate with them, basically. And one of the things I was thinking about is, this isn't my situation and wasn't my situation, but what if I was someone who had cash left at the start of this week in my ISA and space left in the ISA to put it there and time running down, basically? What would I kind of do there? I mean, you can always roll the cash over if you deposit it for a year, but I sort of think if I was planning on investing kind of on the regular, what would I want? And I think actually this year I'd be pretty happy if I had cash left. I've got cash now and I'm pretty happy about having that available. But I thought I could imagine a situation where you get to the kind of end of your month that you've chosen to invest your however much in your 1650 or whatever it is you invest each month. And you look around and think, I really don't like the look of very much of this at all, but if I'm going to keep investing and keep staying regular, I have to go buy something. And I think I would find that more challenging as an investor, finding myself with cash and thinking, I don't see anything I want to do, but I'm supposed to invest that this month. And time running down on me and thinking, this needs to go somewhere, and the good opportunities kind of happened, and I really like what I did back then with, I don't know, Lloyd's or whatever it is you were buying. But that's not available anymore because that's run up like I thought it would run up and so on. So I've decided to be a little bit more, I guess, higher conviction, I suppose, in my, or have a bit more courage of my convictions, I guess is the way I would put it. And there's a reason for that has nothing to do with the kind of opportunities at the moment. But I've sort of decided that where I see stuff available, I'm going to try and take it, because the other thing weighing on my mind is that I find over the last couple of years, we've had a few kind of things that have made markets go in funny directions. I mean, Russia invading Ukraine, a good example, right? Stocks suddenly start going down. Various things have caused them to rip higher, but go back a little bit of vaccine. If you were sat around waiting with cash at that point, as I was, you suddenly found things looking an awful lot less attractive than they did before. So I've decided that there's enough kind of exogenous shock stuff that will move a market in one direction or another, so that I don't feel comfortable waiting around when I think I see a decent opportunity. I'm going to go take it, and if it goes down from there, well, I've got another 20-something years at the very least until I'm looking at using this stuff for retirement. So I think I'll take it where I think I can see it at the moment, and that's the way I'm thinking of going about these things.
It's definitely one of the things I noticed last year, is that I think I had plenty of good ideas about stocks, but I was only ever able to shuffle a couple of £100 in them here and there, and and they would run away to the point where you think, okay, this is less attractive now. I mean, the amount of times I've written to you and said, look, this is up 30%. What the hell am I supposed to do with it now? I don't want it at this price. I've only got a little bit of money in it, so building it out now would be, I think damaging to the position, buying it at the wrong price. So what do you do with it? And you end up cutting it. And I think if you could just have a bit more courage in your convictions at the beginning, that might have been beneficial to me last year.
So just moving on to a kind of taking the third question second in that case. Here's one of the reasons I think I'm minded to be a bit more proactive when I see opportunities here, or maybe not proactive. I don't want to be in front of them. I just want to take them where I can see them. I guess when you have a portfolio that gets bigger, and I'm not saying because I'm a gun investor, I'm just saying because I put more money into the damn thing over a period of years. Any year's ISA, I was going to say ISA allowance, and I kind of like that expression, but a colleague of mine this week said she doesn't like calling it an ISA allowance because it makes it sound like it's something the government gives you. And it's not. It's your money that you put in there, right? But the amount that you're allowed to kind of protect from tax on gains. But yeah, each year's kind of ISA allocation or whatever, that becomes less and less of your overall portfolio. So if you imagine sort of in 8 years' time and imagine you've maxed your ISA for the last 8 years and you're now in year 9 and you're going to throw 20 grand at something. Well, you probably have quite a lot of 20 grand sized things. Another 20 isn't going to make something be, 85% of your portfolio or whatever, which is probably more than someone might like. And I think I'm just starting to edge to the territory of thinking, I'm not going to lump it all in on one thing, and I can't lump it all in on one thing. I haven't got it at the moment. So the policy of keep taking things when they're on offer, if the price of stuff I like keeps going down, I will keep buying it, although a falling share price means it will be less and less and less of my portfolio as it goes along. But I think I'm at the stage now where even if I lumped it all in on one thing, it would only just reach a kind of eye-catchingly big allocation of my portfolio. I think this becomes a lot easier when you've just been investing longer. Let's not say when you've grown your portfolio or anything, right? I'm not going to start going on about investing results here. Just the period of time means that adding another year's worth of ISA stuff doesn't move the needle that much.
Yeah, that's definitely the case. I think I'm not entirely sure what size that needs to be before it happens, but I do fully understand your point here. I think it is easier when you've got a couple of million in there to just bang 20k in something, isn't it? And make a move and be sure about it, because in the grand scheme of things, 20k on 2 million, it's not a massive move. If that was to imagine losing 20k, Steve, and just thinking, never mind. I mean, that's going to be a strange feeling, isn't it? I guess, but there's plenty of stuff moving about, Steve. That's the beauty of this market at the moment. I mean, no idea if we're at the bottom or not, but I mean, there's been days just this week where stuff's moved 2, 3, 4%, and there's no news to move it there. It's in no worse a situation than it was the day before. And every day that this goes on, we're one step better to the recovery and reaching the bull market. So I just don't know. I think me and you have never struggled for opportunity. We've always found something that we wanted to buy. But especially so at the moment. I mean, I had a list of 12 or 13 stocks that I sent to you that I've bought just today.
Nice. You're busy then in that case.
Would you like a list, Steve?
I think the viewing public would love a list. I already have a list, but yeah, go for it.
Okay, so just today I've bought Forterra, Nintendo, Middleby that we spoke about last week, Mid-America Apartments, I think we spoke about that one a couple of weeks ago, Four Corners Property Trust, I think we spoke about that one about 6 weeks ago. I bought Charles Schwab, which is a position I've just started building out, Deckers, which we spoke about 3 weeks ago, Alexandria Real Estate, which we spoke about 50 episodes ago, the S&P Small Cap 600, which is an ETF for profitable small caps. Then I also bought VAT Group, which I did a deep dive on about 6 weeks ago. Next, Entain, Euronext, and a little bit more Barclays.
That is a longer list than I remembered you telling me about, actually. I'd forgotten about the S&P 600, I'd forgotten about Entain, and I'd forgotten about Next. But when I first read your kind of list of stuff, I just had kind of confirmation bias in that case. But I was, and I sent to you earlier, a piece that I wrote last week for the start of this week for full readers to have a look at. It was called Bricks, Banks and Buildings, I think. 5 dividend stocks to buy in April. And I listed Forterra, I listed a couple of banks, I think Bank of America and Lloyds, and I listed Warehouse REIT and Realty Income, which are not your picks in pretty much any of these cases apart from Forterra. And Forterra, that one we've talked about ages and ages and ages ago. I think it was an episode that was just you and me, so that doesn't narrow it down very much. But it was either a stock for Paul or a stock for some month or another that Forterra was yours. I remember looking over it very quickly as you were talking and being quite taken with it. But it's come off a fair bit. So that very much is your pick, and it's very much one that I had a look at and liked. But there's elements of the what I'm going to call bricks, banks and buildings idea going through your thing, although there's plenty of other stuff too there.
Yeah, it was quite funny really when you sent that article over and I swapped it for a shopping list and we were like, like I've read it before. But yeah, it's definitely bricks, banks, buildings, physical retail, and then financial institutions really, isn't it? I think is generally what's on this list. I'm happy with it. Last year, when it came around to the icy year, I was struggling with some of my positions. They were not quite how I wanted them to be, but they were quite red, and there were sort of pains to let them go when the market had fallen as heavily as it had. And I think I sent you this list, Steve, as well. If I can find it, I'll put it up for the watchers. But it was a list of stocks basically that I had as a shopping list for next year, and not many of them have survived, Steve. Most of them are averaging down and looking to get rid of them or trim them or move them to my other portfolio. This time round, I look at this portfolio and I feel a lot happier with where it is at the moment. How are you feeling to say about yours? Because I know sort of middle of last year you were not overly happy with your portfolio. You called it a bunch of stocks.
Yeah, I think I still think it's a bunch of stocks, but I think I'm kind of okay with that. I think I've started taking a much, much longer view. So I'm very top-heavy at the moment as a result of aggressively chasing what I think are the best opportunities at the moment. And I think that's okay for now, because when I think about where my portfolio is going to be, I started thinking this about a quarter ago when I talked about having a big position in Federal Realty, at least a big for the size of my portfolio, right? I mean, you were chucking around numbers like 2 million before. I would point out that mine will not be that. I don't think mine will ever reach 2 million. I think I'll probably stop before I get there. But, well, actually, you never know. Maybe Realty Income goes 10-bagger, but that still wouldn't do it. But yeah, so thinking about the kind of position sizes here, I think of kind of where I want to end up with the size of portfolio and think, well, actually, look, if I buy these now and just leave them, the other things will catch up, or I will find other things that will catch up. I've got quite a bit of a portfolio in a couple of stocks, but they're not going to be quite a bit by the time I get to my kind of retiring number and that sort of number. So I'm not too worried at the moment. It is a bunch of stocks, and there are banks, bricks and buildings in all of these things. They all feel like very kind of, I suppose you might say, counter-cyclical things. They're all things that are kind of falling quite sharply because of a combination of rising interest rates and the threat of a recession, I suppose. Is that part of your thinking, Steve? I know not everything you have there fits into that category, but there's a triple B theme that we might call here. Yeah,
potentially and potentially not. I don't really try to think about what's coming at the moment. I like when we'll talk about it a lot more later, but there's a lot of Howard Marks talk where he tells you that the whole macro thing and predicting macro is just a silly, stupid game to play. And I'm very much of that opinion. I mean, we like to talk about it here. We like to try and guess what's going on, but it's only ever in fun. We would never act upon that. And that's the way I generally feel about my portfolio. I like to score it for risk, and I like to check my risk against my volatility to see if I've got it somewhere right. And there are times when I'm happy to accept a lot more volatility and therefore risk, and there are times when I'm not happy to accept it. At the moment, I am in the sort of process of not really accepting an awful lot of volatility, but it's not mainly because of the macro environment. It's because the stocks that have dropped in value are great blue chippy sort of stocks that you can get at a much fairer price than I could have done a year ago. So I'm much happier to swap to these kind of stocks and then a smooth 12, even though Buffett says he'd prefer a lumpy 15. I'm happy with a smooth 12, Steve. I don't care about a lumpy 15. If you can give me a smooth 12, a lumpy 15 can go and do one. But the reason I've not invested in my top stocks, but I'm top heavy as well, Steve. I've got 7% of my portfolio in Disney, 8.37 in ASML, 8.55 in Alphabet, 9.12 in Amazon. I've been buying them really heavily for it feels like maybe the last 18 months. Now what I'm trying to do is, rather than sell those positions down, because again, I loathe to do that, I'm going to build the positions up around it to so obviously reduce them in percentage in that way. The aim is to bring them all down to 7% and Disney down to 5.5%, but not by selling, by buying.
Yeah, I like that. So I like the idea of kind of just buying other stuff and bringing the allocation down, and that's how your portfolio gets bigger and kind of balances itself out, right? You buy what's cheap at any particular given time for not for whatever reason. Think cheap in terms of what it's worth, not cheap in terms of where its share price used to be. On the macro stuff, I kind of share that view, I think. I mean, I think it's Bill Mann who says this from the Motley Fool, but since I'm not certain, let's say it's Tim Byers, because I'm always saying things that he says that I disagree with. So let's go with something that he may or may not have said that I actually agree with. Someone at the Motley Fool, probably Tim Byers, said, look, here's the kind of issue with macro predicting. So we're all interested in, say, what interest rates are going to be. Maybe they're going to go up by 0.25, maybe they're going to do nothing, maybe they're going to go up by more than that. Well, what is the stock that you want to buy today if they go up by 0.25 that you don't want to buy if they stay flat, or if they go up by 0.5%? Suppose that number's slightly bigger, suppose that number's slightly smaller. What stock do you not want to buy today because you want to kind of buy it tomorrow? Well, there probably isn't one if you're thinking of it from a kind of investor perspective. So if you're thinking about the underlying business, I can't think of a business that I think is going to be materially different with a difference of an extra or less a 0.25% in interest rates. Same goes for if inflation comes in at 10.7 rather than 10.6 or something like that. I can think that the market might do stuff that will offer me a better opportunity if that number comes in higher in both cases. But I'm not particularly sure as to whether I think it's going to do that, which makes it hard for me to sort of do anything. So I quite like the idea of thinking, well, what matters here is businesses, and focus on those and buy them at the right prices. Yes, we'll come back to that in a bit with the sort of Howard Marks stuff. But I struggle to think of a business that I want to buy if rates are going up more than I expect or less than I expect.
And that, again, just to go back to the Motley Fool, there is another great saying. I think it was Chris Hill who said it. He's never, ever not bought a stock because there was going to be a different president coming in, and he's never, ever thought about when he was going to buy a stock. Hang on a second, who's the Fed chairman at the moment? Do you know what I mean? They're just not things that factor into people who are planning and buying and holding for a long time's decision. So I'm trying not to think about them. It's very difficult, actually. It's another one of those investing things that sounds really easy, but when you log on a day and everything's up 3 or 4%, and there's a rosy macro story out there, you do tend to think, well, we'll just maybe see, and that's not the right attitude. But it's something we've probably got to work on, which is an investing thing. You're never going to get there. You're always going to be improving. And again, we'll talk about Marx's podcast soon, because it's something we've got scheduled to talk about. But even he will quite regularly spend the first part of his memo correcting the things that he believed in the past that are now not correct. So he's one of the best investors in the world, and he's still learning.
So it sounds like we're both going for it then, this kind of ISA season, and going for it in maybe some similar areas to start off with, I guess. There's a bit of overlap between my stuff and the stuff that you were mentioning, and there's some stuff that isn't, but we're never mind. We're not even going to pretend to not lump it in this year.
Yeah, well, we'll see. I said I'm not going to lump it in, but then when I made all these balancing things, I realised they still weren't quite as balanced as I want, and I had this money sat down, which I thought, I'll just keep that one to one side. Now I'm already kind of like, if the markets were open tomorrow, it'd probably be in, Steve. Let's not lie to each other.
Oh, I'm putting it in, and you, by the sound of it, sound like you're going to put it in and take it out, and put it in again and take it out again, and that kind of thing.
Yeah, and splurge it all over some stocks.
That's it. Excellent.